Hello, everyone. We're still rounding out some attendees, so we'll give it a couple minutes and we'll get rolling with our presentation. So stand by, please. If you've just joined us, we're going to give it another 30 seconds or so for others to join, then we'll get started here. All right, we'll go ahead and kick it off. Welcome everyone to our quarterly Making Sense of the Market call. I'm joined as always by my esteemed colleagues, Eric Kraus and Will McGuff. If you haven't joined us before, this is our quarterly update on the markets and the economy and all things financial. And for recording purposes, this is July 17th of 2024. If you haven't met Eric yet, he's one of our portfolio managers, leads one of our offices, and Will is our chief investment strategist. They will guide us through this conversation. For those of you that are newer to Prime Capital Financial, just a quick snapshot of who we are and what we do. We serve both wealth management clients, retirement plan clients, as well as institutional clients. All told, we service approximately 14,000 families, over 600 retirement plans, in total over 26 billion of AUM, across 170 advisors, 170 very hardworking associates in 40 markets, with clients in 48 states. Before we get rolling to the informational slides, we always like to set the stage and just provide some context based on what's happening in the broader world. And we'd be remiss if we didn't start by acknowledging the horrific events that took place in Pennsylvania last week at former President Trump's rally. And I think we at Prime Financial, as well as our loved ones and our family and friends, all just want to acknowledge what a horrible incident that was and how hopefully our country can move past this quickly. And you'll see in some of the headlines, we're hopeful that that's actually happening, that we're coming together as a country to continue to do great things. So with that, let's look at some of those current headlines. Obviously, on Friday, we had an astonishing and shocking attempt to assassinate an ex-president. Right in the midst of a very contentious presidential election cycle. Some of the headlines of the Financial Times suggest that both Trump and Biden are calling for a little bit more unity, a little bit more standing together as a nation, which is a good thing that could help lower the tenor of the political discourse in the country. And in terms of the financial outlook, these elections seems to be swinging a bit more in favor of the Trump candidacy. Obviously a lot left to play out, but the markets are reacting to some of the moves and the odds making in terms of the election cycle, which we'll get into a bit later. From a market standpoint, obviously the year's off to a great start. The Dow clinched its best day in more than a year, and the S&P continues to hit new record highs. And under the surface, we're starting to see some participation for some of the smaller cap, middle cap portions of the market that haven't kept up as much as the large cap leaders of the space. From an international standpoint, we still obviously have some simmering tensions in both the Middle East and the Ukraine. And from an economic standpoint, continued concerns about Chinese growth, which is obviously the second largest economy in the world and a key driver globally. In terms of US financial markets and financial policy, we had a good inflation report a few weeks back, which is coming in conjunction with a cooling labor market. So the Fed is pivoting from maybe a single mandate about price stability to pay more attention to the labor market softness and trying to walk that fine line between getting inflation down to 2% without causing too much unemployment or too much economic turmoil. On the back of that, we also have tensions in various parts of the market. Home prices are hitting a record, and we're starting to see some signs of stress in localized real estate markets, which is always a key and important signal. And in AI, it's continually a topical segment. Obviously, some of the larger capitalization technology firms have really led the market higher this year, but we're seeing and reading and studying more about, the revenue that's going to have to come to pay off for all this investment that's being made. And we'll dig into that in full detail at the back section of our presentation today. So now that we've kind of set the stage with what's happening more broadly and what headlines we're reading every day, I'll direct this first question to Eric. Eric, how does this first half performance compare, or I'm sorry, I think I'll direct this one at Will instead. Will, maybe you can walk us through this. How does first half performance compare to prior years?
Yeah, thanks for joining everybody, and I'll start there, almost put Eric on the spot. So as you mentioned in your headline wrap, it's been a great start to the year. The S&P is almost up 20% at 18% on the year, and this is through June 30th. And so what I would like to highlight here is when we had this call last quarter, it was in early April, and you'll see the red dots on these charts represent the lowest drawdown decline during the year. And we actually had the 5% decline in April. The whole month of April was pretty much steady downdraft. And it just goes to show you the value of having a plan and sticking to it. There's going to be volatility in the markets. We're up almost 20% when we had a 5% down month just a few months ago. So it's important to work with your advisor and not overreact to those down months, because that's ultimately how you compound your investments higher, is going through those down periods. On the next slide, we'll show you how bonds have done this year, and you'll see that there hasn't been much return at all. The bond aggregate's up about 1%, but still to this day, that 2022 number is going to stick out. Everybody remembers when stocks and bonds were down in 2022. So we recovered from that, but bonds for the most part are still underwater. We're down 13, up 6, up 1. We're still below levels there. The 4% loss actually happened at the start of this year. So interest rates went up, which means bonds went down. And so it's been a long grind since then, where bonds have gotten back to a little bit positive on the year. So that's just two asset classes, stocks and bonds. The next chart is commonly referred to as a jelly bean chart. And here what you see is a lot of colors on purpose, because the colors represent different asset classes, which our diversified portfolios typically use. And what you see in the middle is the white asset allocation chart box that shows you how the asset classes will out and underperform year over year based upon different factors, which some we'll discuss the rest of this presentation here. But you'll see you can smooth out the ride by maintaining a diversified portfolio. Everybody knows the Mag 7's been driving the market. I don't want to steal Eric's thunder this time. So large cap stocks are at the top, and it's driven by the Mag 7, which I think we're going to get into next.
Yeah, so Eric, maybe I'll kick it over to you. Will kind of teed you up, but let's talk through the Mag 7 and what's been happening under the hood here.
Let's do it, just to prove this isn't scripted, right? That's perfect. Well, that's right. What's been driving the market has continued to be this magnificent 7 performance, those top stocks, top technology stocks, and specifically AI leveraged stocks in the S&P 500. And these numbers are just so powerful, it's worth reviewing what happened last year and that trend that's continued so far this year, at least up until this week. And even today, we can talk about some of the even more recent headlines there. But if you zoom in on that 2023 number, you see that the Magnificent 7 had a 76% return. Rest of the S&P 500 had an 8% return. So if you weren't participating in those top tech names last year, you had a modestly positive return, but certainly not to the same tune of that very strong S&P 500 return that we had in 2023. It's really been the same story so far this year. Magnificent 7 stocks that returned 38%. Rest of the S&P 500 returned 7%. So there's been this huge disparity between winners and losers. And the question we get asked, is that all just hype or what's going on? But if you look at that chart on the right-hand side, we can see that it's not just all hype, it's based upon earnings growth. And we see those big green bars, that represents the earnings growth that we've seen in the back half of 2023 and into 2024. Just huge numbers as this arms race between the world's richest companies with billions of dollars of cash, all racing out to spend money on the same stuff. Naturally, it's going to drive earnings for semiconductor stocks. So what we see on a forward-looking basis, though, a little bit more hope for diversified investors, is you notice that those green bars, as we look forward, third quarter, fourth quarter of the year, still strong numbers, but high teens is a lot different than 50% growth rates. So that should help, maybe normalize the trends just a little bit. The thing I would contrast that with is the blue bars, which represents the rest of the S&P 500. And you can see that they had more meager earnings growth and even negative earnings growth in the first quarter of the year, the rest of the market. So pretty remarkable when you see that spread, 50% earnings growth versus -2. But the way the forecasts are lining out, we're starting to see some of this rotation, is we're starting to see the rest of the market have a little bit more optimism in the back half of the year. So it doesn't necessarily mean that the Mag 7 have to crash or that there's this big correction coming necessarily, but hopefully we'll have a more balanced profile of returns on a forward-looking basis. I think that's significant if we look at the next slide here as we think about valuations and where things stand. What's been driving the S&P 500, we see those big disparities of return. That's caused this huge amount of concentration on the right-hand side of the page. So the top 10 stocks in the S&P 500 almost at a record level of representation in that index. So that's why their performance has continued to drive the overall returns. So maybe we'll see some of that come back down to earth just a little bit. And I think that would potentially be a little bit more healthy if you just kind of scroll over to the left side of that page there and we look at the price to earnings multiple of those top 10 stocks, currently at 33.8 times forward earnings. That's a little bit scary. Just obviously those earnings growth rates are still impressive, but the rest of the market still may be expensive relative to history, but only at 17 times earnings. Anything to add there, Scott?
Yeah, I would just, for those of you that don't know the names that represent the Magnificent Seven or even the top 10, Microsoft makes up about 7% of the market, Apple's about 6%. So household names, great world-class businesses. When we score things out on the quality metrics we look for, these are some of the top quality companies in the index, and their earnings power shows it. The next one would be NVIDIA, which is about 6 or 7% of the index, which has been the star of the markets for the past 3 years. And we'll talk more about them, but they're in a unique position as the critical component supplier to a lot of these big tech companies that are building out compute capacity to serve AI. Next on the list would be Meta, Google, Berkshire, Eli Lilly, and JP Morgan, and those range from about 1 to 2% of the market each. So in aggregate, that's 37.5% of the market. But relative to past concentration cycles, I would say, at 33 times earnings, it is certainly lofty relative to the rest of the market, but it's not quite near the nosebleed levels we saw during the tech bubble, where you had, I would argue, maybe some less fiscally sound companies with even more elevated, sometimes twice as high of earnings ratios or forward earnings ratios relative to where we are today. So I think Eric's spot on. It's certainly something we pay a lot of attention to, and I think with the rotation we're seeing in the market and some of the economic trends coming forward, our expectation would be that this will probably broaden out a little bit into more segments of the economy that haven't participated to the same extent. Will, would you have anything to add to this slide?
Not really. I just highlight 99 again, where you mentioned it was 33 times back in 99. If we look at the charts on the right, you'll see the earnings contribution at the bottom was about 15%, and now it's 25%. So you've got, I think a better mix of information here with lower PE relative to 99 with higher earnings contribution. Just makes this one a little, probably a little better in my opinion than what we saw in 99.
Yeah, real quality companies making real earnings is a big difference than pets.com, hopefully, right? So that's kind of as we think about wrapping up this particular question, what's been driving the market, Scott, I think I'll skip over this slide and get on to sentiment, because that's been really the other thing, the momentum. And sentiment is not necessarily a bad thing. If you see things go over towards greed, that can, momentum is positive in the market. Sometimes it can drive things higher. But we always want to be cautious as advisors and investors to, take Warren Buffett's longstanding wisdom to heart when people are getting greedy, to be a little bit more fearful. And likewise, when extreme fear takes hold in markets, to be a little bit more aggressive. And we're perhaps not all the way over on the far right-hand side of extreme greed, but people are liking what they see, and people get good returns. They hear about these stocks on TV, on CNBC. They want to have some allocation there. So there's probably still some room to run yet for broader markets just on that sentiment alone. But it is something that we watch carefully just to make sure we don't get too overbought or too on one side of the boat with everyone thinking there's going to be one particular outcome.
Yeah, I think that's well said. So Will, maybe you can talk to us about inflation in the Fed. I guess, what are we seeing? What are the trends? What do you think's on the horizon?
Yeah, so as for those that don't know, the Federal Reserve has a two-pronged mandate with unemployment and stability of rates and prices. So we'll talk about rates and inflation first. What you see here is the CPI. It's a government statistic that measures the rate of inflation or year-over-year change of the consumer price index. And again, going back to 2022, 2023, the glut of money that came through after the COVID stimulus just was way too much and was absorbed in the supply side inflation here, and it's waned. Unfortunately, it hasn't gotten back to where it was before, but we're seeing inflation numbers and readings come in around the mid 3% range per year, with the trend being down. So in my mind, that's a positive for the Fed to begin to look towards rate cuts and normalization, which we have, I think, on the next slide. Or no, we're going to stay with inflation here. Sorry, guys. So these are the components of inflation. And again, when the Fed tries to target inflation with rates, they have one rate, so they can't necessarily go in and target energy, auto insurance, or core goods. It's kind of a meat cleaver approach here. So they're trying to control the short-term rates to keep a lid on inflation, but there's some things they can't control, like car insurance, auto insurance, home insurance. But the areas that they are focused on, like core goods, you'll notice the orange bars sneaking below that 0% line here over the last couple of months, which is a good thing. So, so kind of a mixed bag of things they can and can't control, but the things that they want to control more than the others are starting to at least stabilize, not inflate. And you're starting to see some come in a little bit lower, which is a good thing. And ultimately, we'll hopefully get them comfortable with normalization or easing here in the next couple of months towards the end of the year. So for the next slide, we're going to look at the estimated projections of where rates may end up at the end of 24, 25, and 26. So right now we're at 5.375%. It rounds to 3.8 here. And when we came into the year, everybody was expecting a recession, some type of soft or hard landing, and 6 rate cuts. And we haven't seen it. Economy has stayed decently hot, and inflation has come in, so it's given them the leadway to potentially almost move too slow here. If everybody remembers, they were way too late in raising rates, and potentially now with the ECB cutting, Swiss National Bank cutting, the BOC cutting, oil down, economy getting soft, they have the ability to not only normalize but to ease. And we'll see they got 4 meetings left this year, if it's 1 or 2 cuts, which will ultimately help out the markets as we move towards the end of the year. But it's kind of a slow and steady grind lower back to that mid 3% range long-term rate, and we'll ultimately be tracking how consumer is doing, which is in the next couple of sections, and we'll discuss here.
Yeah, and Will, just to dive into this slide again, I do think that it's telling. If you look at what was really driving inflation higher post-COVID, it was energy, core goods, which is a function of supply chain, and a lot of the leisure industries where there was labor constraints and people, eager to get out of the house. Whereas now you've kind of seen energy and core goods flip to, frankly, almost neutral to negative, and general progress across the other fronts as well. And so I think the Fed is highly aware of what caused the problem originally, and the fact that we're down to 3% is a good thing. And as we've said before, it's hard to get from 4 to 2 without a little bit of pain, and that's the tightrope the Fed's trying to walk, is to try to get inflation back down to 2% without implying too much stress on the markets. So Eric, maybe you can elaborate a little bit on this. What is the Fed watching, and what do you think will dictate how they react over the next 3 or 4 meetings?
Yeah, it's a good question. And I think we've touched on it just kind of lightly already in the presentation, that dual mandate between inflation, which has been front and center for the last 2 years, and also unemployment or full employment, seeking full employment for the economy. And I think the most notable thing that we've seen in Powell's testimony and his tone shift is that it's a bit more dovish, meaning he's suggested that they're not going to wait for inflation to get down to 2% before they cut interest rates. So he's sort of removed that artificial barrier of that monthly CPI number being right at 2% before they start cutting things to avoid, to Will's point, holding on a little bit too long here. Because they see these numbers, which we're going to flash on the screen here, which is a pretty significant reduction in labor demand. Now, certainly things got out of whack there for a while with the kind of great resignation and the amount of job openings relative to people searching for work. So this is healthy. This normalization is healthy, but we don't want it to swing too far in the other direction. What we see on the next slide when we look at labor supply has come back online to a degree. Labor force participation, while still below in aggregate the levels that we saw pre-pandemic, has certainly increased significantly for that group age 18 to 64, even above the pre-pandemic levels, although we've seen some kind of modest pullbacks here recently. So this is what they're watching. They're watching those monthly jobs numbers, the data they're getting, interviews with CEOs and CFOs around hiring and belt tightening and what might be going on there. And they're aware of a potential impact of AI here too. I mean, what's that going to do long-term to the labor force? Does that put some pressure on some jobs, or at least some readjustment of job positions over time? So we'll continue to watch that. But if we look just at the next slide here, we start to see a convergence. These numbers on this chart, this illustrates the unemployment rate, the 50-year average, along with wage growth. And these numbers tend to fly apart. Wage growth goes down, unemployment goes up. Then unemployment starts coming down, and wage growth, they tend to kind of move together and then come back apart. We're now at this phase where wage growth is close to 4%, and unemployment's also around 4%. That's a pretty good equilibrium rate, so it provides long-term raises and numbers above inflation for the average worker to make more money each year, but without pushing that unemployment rate too much higher. We'll see how long that's sustainable. Again, looking back at history, unfortunately, those numbers don't tend to stay together for too long. So we'll be very mindful of that to see if there's any uptick in unemployment that we need to account for. But beyond just these jobs numbers, I think they also look at the strength of the overall consumer. And obviously, having a job is a good indicator of consumer strength on one hand, but there's other factors underneath the surface that we want to be mindful of. One of those is the personal savings rate. And interestingly, I've seen some articles recently on CNBC and the Wall Street Journal that suggest people that are saving inside 401k plans are actually hitting record highs. So there are some people that are still saving at a really healthy rate. And I think that, for our retirement plan listeners out there, just furthers the importance of those group retirement plans and helping people get to successful outcomes. But in aggregate across the country, the savings rate's only 3.8% year to date in 2024, which is certainly not enough for most of us. That just illustrates the pressure of inflation that we've been under here. And if we look at the next slide, I know we've hit on this before, but we're continuing to monitor these flows into early delinquencies on credit cards and in student loans. Obviously have been stagnant for quite some time, but also on auto loans. And those overall household debt service ratios started to creep back up. Some of that's tied to interest rates, of course, but if we're already seeing flows into early delinquencies with nearly record low unemployment, if those numbers do start to tick back up, you could see some domino effect or some acceleration here, which, again, we're a consumer-driven economy. Perhaps the consumer can pass the torch a little bit here to enterprise spending to keep things going. All this excitement around buying semiconductor chips and whatnot that's going on in the world's largest companies. But ultimately, the consumer is very important for the economy, and certainly it's going to be a big talking point for the election with where sentiment stands today.
Yeah, no doubt. And I think it's, we didn't really zoom in on this, but this upper right-hand slide on the consumer savings and borrowings, this peak XX savings post-COVID of $2 trillion that's been steadily whittling down over the course of 21, 22, 23, into 24. In the chart, this bottom right-hand panel here that shows the delinquencies popping back up, I think there's an implied connection there. As people draw down their savings, they're a little bit more reliant on wage growth and employment to service debts. I think we can skip this one or just touch on it. Obviously, the macro outlook has gotten a lot better. About a year ago, economists were predicting over 60% chance of recession. Now it's down to 30%. We don't put too much stake into this. It's more of just an indicator of kind of what the market is expecting. So a 1 out of 3 chance of a recession in the next 12 months. But we focus more on kind of the macro indicators more broadly than this just single aggregate stat. Okay, so next, let's talk about the election. I'll leave this to whichever one you want, whichever of you would like to take it. But we've obviously had some pretty obvious shifts in probabilities of what the outcome might be. What do you guys think the election will have? What impact do you think it'll have on the markets?
Well, I'll take a quick stab at it, I guess. Themes and recent events, it's caused, you flash the numbers up on the screen there, some of the snap polls and snap reactions tend to favor more likelihood of a Trump presidency and perhaps a higher likelihood of a Republican-controlled Senate and House of Representatives, maybe a 51% chance of Republican sweep. We did look back at history and what happened in 2016. The sectors that tended to outperform after a Trump election tended to be energy, financials, small caps, value names, industrials, with that focus on American exceptionalism. Perhaps more tariffs. It may impact some of our foreign allies or adversaries, depending on how broadly they're applied, which could be inflationary. So there's some things that are out there, I guess, pros and cons, but generally speaking, it would probably be viewed as good for markets and good for economic growth, at least in the short term, the market perception of that. But there's other factors in play there too. Will and Scott, I'm kind of curious what your thoughts are on that recent kind of shift in things that we've experienced.
Yeah, go ahead, Will.
Yeah, I would generally say the markets are a discounting machine, so they like a little bit of certainty. And with regards to Washington, D.C., it's either a certainty that it's going to be dysfunctional, so nothing's going to come out of Washington, D.C., or in the case, the scenario that we're looking at for later this year, the odds of more of a Republican-controlled environment just gives the markets more certainty to figure out which areas or themes are going to benefit or not from the various policies coming out of DC. So I think it's healthy for the markets, kind of in those two binary cases of uncertainty or certainty, that what's going on in the political climate's tending to be a little bit more predictable than most other election years.
Yeah, and I would say in terms of what's notable, I think, is what is not being discussed by either party, which is the federal balance sheet. Obviously, the federal debt has ballooned a lot in the past 2 or 3 years, but we're really not hearing much conversation about that. And so if we kind of stay on this trajectory of somewhat profligate federal spending and we move in a direction where we might be imposing tariffs and possibly even reducing the labor pool with tighter immigration policies, I do think that tends to lean more towards a more modestly inflationary environment, as opposed to, if we're hearing more talking points about, federal balance sheet control. So I think that's one thing that sticks in my mind as we think about fixed income markets and longer duration markets, irrespective of the Fed's actions on short-term rates. And then more broadly, I think that, to the extent we do get a more broadly Republican-controlled parts of federal government, I would think that should benefit a more broad segment of the economy. U.S. domiciled, more U.S. revenue-centric companies that would not be exposed to any tariff pressures would be an area of interest. And obviously, you're starting to see some rotation into small caps, as well as some of the financials that could be beneficiaries, as Eric alluded to.
One thing I would just add there, Scott, and it's sort of related to this slide here on sentiments. I think obviously everyone's frustrated with inflation. From a portfolio perspective, it's our job to maybe be mindful of those kind of sector, ups and downs that may take place with one party or another. We have a slide I think we've shared before where we just kind of showed that the long-term trajectory of the markets are somewhat apolitical. But from a financial planning perspective, you can see dating back to 1933 that Republican Democrat doesn't really matter that much over the long term, that markets ultimately drive on innovation, American innovation, good quality companies we're investing in, not politicians. But I would note that from a financial planning perspective, we'll of course keep an eye on the tax cuts that are due to expire in 2020 at the end of 2025. That will have a significant impact on a lot of our clients and their strategies. So obviously, if you get a Republican sweep, you're more likely to see some form of extension there. Versus if there's too much division, it may be difficult for governments to pass those, which on one hand may help control deficits, but at the same time could cause a little bit of a shock to corporate earnings if that tax rate immediately pops back up. So that's not going to happen on November 5th or November 6th or January 1st or the first 6 months. But as we start to discount that in, to Will's point, the market's a discounting instrument. You will start to see the impact of those potential corporate earnings taxes going up if that does not come to pass.
Yeah, I think this chart is probably the most important one, which is to Eric's point. While it's interesting in our job to try to navigate the sectors that might benefit on the margin relative to who's in control over the long term, American exceptionalism wins out. So another key question we've been getting from our clients is around artificial intelligence. It's obviously been driving the market, and there's questions of whether or not we're in a bubble. Over the past month or two, we've done a pretty deep dive into artificial intelligence, thinking through what sectors it might impact, what the macro implications might be, which firms are set to benefit, and what we think is priced into the market. So without going too far into the weeds, hopefully, I'm going to try to just give an update on kind of what we're thinking about the implications of AI on the US economy. So starting with adoption, this is a great survey chart that Goldman Sachs summarized about a couple weeks ago. This is based on US Census data, and this is the percentage of firms in various industries that are using generative AI to produce goods and services. So actually using it in their work functions. And I would say we at Prime Financial are in this group. We are using generative AI for research functions, for some accounting functions, and various tasks that otherwise would require dedicated man hours. But if you look at this chart, the light blue is what percentage of firms in each industry were using generative AI as of October, and the dark blue, not the white, but the dark blue solid line is what portion we're using it as of June. And you can see that there's been a pretty steady uptick in terms of usage in production of goods and services across a lot of industries, and especially in the ones that you would think would be most likely to be early adopters. Informational, professional, scientific, and technical fields, education services, finance and insurance. These are all things that intuitively you would think are pretty labor intensive, a lot of white collar employees doing thought work, where these generative AI models can really add benefits. More importantly, I think, is the white bars here, which is expected or planned adoption into production functions over the next 6 months. You can see that the trend is pretty positive. More firms are looking to adapt and try and use generative AI in their production functions. If we zoom out, I think it's worth mentioning kind of just the traditional adoption curve that we've seen over time in technology. This curve here, the solid black line, is what's known as an S curve, because it kind of looks like a flattened out S. And then there's really 4 main phases to technology adoption and what that implies for market penetration. There's the innovators that start, and there's the early adopters. Innovators is when there's just a few people, maybe 1% or 2, trying something out to see if it works. Then there's the early movers that try to move more forcefully, more adaptively to implement new technologies. Once these early adopters kind of find good use cases is when you start to see the steep part of the curve, where you have the early majority and the late majority really start to use a technology at scale. And then finally you reach maximum penetration once the laggards finally start to use something. And I'd say with respect to AI, we're still in this flatter ramping part of the early adoption curve. Those stats above, those are number of firms that are using generative AI in those respective industries, but that doesn't really speak to kind of how broadly or how impactfully they're using them. So when we look at the data, we think we're in this probably 1 to 5% range in terms of who's using it for real function. If you look at over time how these S curves have trended, it's pretty amazing. Like, this is probably my favorite chart in this whole deck. This shows the adoption of various technologies over the past 100 years. And what you'll notice is there's older technologies on the right and newer technologies on the left, and the lines get a lot steeper. So if you look at the car, the telephone, electricity, airplanes, those looked a lot like the S curves on the prior slide. But when you move more towards more recent innovations, even the internet, TV, and especially with cell phones and PCs and telecommunications, those are steeper curves where you start to reach pretty quick penetration within 10 or 20 years, as opposed to older innovations from the industrial revolution or manufacturing revolution that took multiple decades. And so we keep this in mind when we think about AI. Our thinking is that we would expect AI to be more of one of these steep curves as opposed to something that takes decades to pan out, just because you have a society that's already kind of geared towards digital data intensive technology adoption, having just integrated personal computing, internet technology, and mobile phone communications in the past 20, 30 years. And when we look kind of historically about what this adoption does to the economy, we showed this slide, I think, in a prior webinar. But what happens is, as these adoption curves reach about 50%, you start to get a bit of a productivity boost in the economy. With the development of the electric motor, that was in the late 1890s. In about the 1920s, 1930s, there was a pickup in US labor productivity. Same thing with personal computing, which was invented in 1981. It was about 20 years later when you started to see that manifest itself in some better productivity numbers in US labor productivity. Again, though, these were relative to the pace we expect in AI, a little bit more drawn out, where it wouldn't surprise us at all if the adoption in AI is a little bit quicker. What we did next is really kind of dove into the past three innovations and kind of how those impacted US GDP growth and US productivity growth. The red squiggly line is US GDP growth on a 10-year average, and the I think it's gold or yellowish squiggly line is productivity growth. And what you see is from about 1997 to, call it 2013-14, there was a pickup in US productivity. At the same time, you didn't really see a step change higher in GDP growth. In fact, rolling 10-year average GDP growth has been kind of flattish from the late 70s to the early 2000s and been kind of muted over the past 20 years. But when you look at those dotted lines, which show the adoption, the penetration of computers, internet, and smartphones, it would seem that the combination of internets and computing probably did have some impact on US productivity. And we would expect, at least for certain sectors, that to play out with AI as well. Now, when you think about what sectors and what kind of jobs technology impacts, we think AI is going to look similar to internet and computers. It's more white-collar jobs, it's labor-intensive service industries in the professional sector, scientific sector, research, technology, and finance. And if you look at the percentage total GDP that came from those sectors during that past productivity increase in the late 90s, early 2000s, these didn't shrink as a portion of GDP, they actually grew. And if you dig in, the number of employees stayed relatively consistent over that period of time, but people made more money. The workers in these industries got more productive because they used the tools. And so if you looked at how much total wages were going to these sectors, they actually increased. So while these tools might intuitively be thought of as things that eliminate jobs, in reality, what they actually do is they just add productivity to these sectors, to the firms, to the companies that can adopt them quickly and take market share. Now, let's kind of dig into kind of the big thematic question, which is around how much is being invested in AI and whether or not we think it's sustainable. We've done some research with respect to the hyperscalers and NVIDIA. A hyperscaler is just a term that's used to describe these massive data center companies. And for those of you that aren't familiar with data centers, 20 or 30 years ago, everybody did their computing on the same premises. You'd have servers and mainframes in your office, in your warehouse, in your back room, and you'd do all your computation right there on premises. What's happened over the past 20 years is a lot of that has moved into what's called the cloud, which is you're basically sending your data over fiber optics to remote locations that does all your compute for you and then sends the information back. Hyperscalers are these massively scaled data center companies, including Microsoft, Amazon, Google, Meta, formerly known as Facebook, and Oracle. And when you look at what analysts are estimating for the revenue growth of those companies have grown revenue, those 5 or 6 have grown it from about 60 billion in about 2019 to a little bit over 100 billion, 150 billion currently. And going forward, that growth is expected to continue. But when you dig into the estimates around NVIDIA, it seems to be implying more significant growth in this sector than what's being implied by these actual operators. And I think this is an important point because NVIDIA is unique in that, at least historically, about 40% of the revenue came from these hyperscalers. So in our seats, we actually have a pretty good window into what the customers are planning to do relative to what the supplier, namely NVIDIA, is expected to do. And so we think this is an interesting sort of divergence in what seems to be implied in NVIDIA relative to these companies. Going a little step further, what we did is we tried to extrapolate when you invest in AI, when you're building out data centers, you're doing it so that you can earn more revenue and earn more profits. And presumably, if your CFO is good, you want to earn a good return on capital for that investment. historically, the data centers have probably earned about a 15 to 20% return on capital on their investments. And the data center software industry typically does 30% margin. And so when we look at what's implied by data center CapEx, it would seem to suggest that these companies are going to continue to grow. What this solid blue line shows you is data center revenues over the past 5 years and then projected going forward. If you look at that dotted blue line below, that's what the trajectory it was on before this AI revolution started. So the market is already sort of factoring in some enhanced revenue growth from these companies. What we did is we took it a step further and we tried to derive from NVIDIA's estimates in terms of what the street is expecting NVIDIA to do to see what that implied for the revenue growth of these companies. And we think that there's a bit of a premium being assumed in NVIDIA, whereby the revenue growth is higher than what seems to be implied by where the analysts covering the data centers are projecting. And so when you kind of zoom out, there's about 100 billion of additional revenue that the street's already sort of baking into these data center companies in terms of growth. That doesn't seem totally unreasonable. But to get to what NVIDIA is implying, it's probably another 200 billion of revenue. And if we look at the bottom, all the way down here at the bottom, this little gold line, this is the amount of revenue these data centers are getting from AI applications. It was effectively zero just about 18 months ago. We now think in 2024, it's probably going to be about 5 to 10 billion. So the market is assuming a pretty massive ramp in AI related revenues. And you can almost visualize that S curve, if we were to overlay it here, a pretty healthy ramp over the next 3 to 5 years to really prove out the revenue, the earnings, the return on capital case for all this investment. In terms of, framing this relative to the broader economy, we look at it this way. So there's probably about 100 or 200 billion of additional revenue that needs to be earned by these companies that are buying all these semiconductor chips. Is that a reasonable number? What we did is we dug into about a half dozen sectors per the Bureau of Economic Analysis that we think are most likely adopters of AI technology. That would be professional, scientific, and technical services, finance and insurance, information technology, administrative services, management, and other. And if you look at those as a percentage of GDP, they're about 28%. They represent about a quarter of total employment and about 34% of total wages. And if you look at that middle column, annual pay per employee, these are pretty high paying jobs. The total GDP, the average earnings of the US labor force across 140 million people is about 80 grand. Whereas these sectors that we think will be adopters of AI, these are the high earning sectors, generally speaking. These are professional white collar employees where there's a pretty good incentive by management to try to find ways to make them more productive. And so what we did is, all the way on the right, we assumed a percentage of that total spend on wages for each of these sectors and said, what does that equate to if there's 5, 10, 15, 20% productivity gains from AI? And if you look at the bottom, the red box, a 5% productivity gain from AI implies about 0.2 trillion of GDP growth or productivity gain. And 20% implies about 0.8 trillion GDP growth or productivity gain. And so when you think about that in the context of 100 to 200 billion of data center revenues, you can see that that's probably the range the market is expecting. If a company is going to pay a data center another 100 or 200 billion dollars to run these models, then that firm, the software firm running the model, is probably going to want to generate 2x that in revenue. So if the data centers are going to earn 100 to 200 billion, that's probably 200 to 400 billion of software company revenue. And at the end of the spectrum is these firms that will be buying those services, buying this new software to make their employees more productive. And so if you do that math, if someone's going to pay about 200 to 400 billion for software services, they're going to want to generate a multiple of that in terms of productivity growth. And so we think what the market is kind of discounting is this probably 10 to 20% of productivity gains in these sectors. And the key question is how quickly that is going to pan out. When you zoom out and look at this cycle relative to past similar instances in the tech space, The biggest, most common example is the tech bubble, the telecom overspend in the 90s. For those of you unfamiliar with it, once the internet got rolling in the 90s, there was this big push to build out fiber optic networks in the US. And there was a lot of TMT companies that spent a lot of money building fiber that took a long time to actually get used. There was a bunch of supply put in the market in anticipation of demand that actually took about 10 years to get filled up. What's different now, if you look at this table on the right, is just the level of investment happening now in these big TMT companies relative to the late 90s. At that time, those companies were spending almost 100% of every dollar of cash flow to build out their networks. And that's in combination of research and development and CapEx spending. Now it's a little bit more muted, it's about 80%, and these are generally very healthy, very profitable companies. So we have to monitor this and make sure that the CFOs, the management of these buyers of AI chips are being prudent in earning a return on capital. But as it stands today, their balance sheets are in a little better shape than they were for the TMT companies in the late 90s. And on the left, just to kind of set the scale of this investment that's happening, it's very, very large. The light blue line is aggregate S&P 500 CapEx and R&D, and the dark blue is the percentage being spent by these hyperscalers. So it's 350 billion. That's about a quarter of all U.S. S&P 500 CapEx. And so you can assume that these companies are going to be very focused on seeing revenue production off of this investment they're making, and that's a trend we want to pay very close attention to going forward. To summarize on AI, we draw 5 main conclusions, and we wanted to introduce one chart that kind of helps think about this technology change cycle. On the right, what happens is when a new technology is launched, there's a lot of confusion. People don't really know how to use it. There's a lot of optimism, but not a lot of know-how. And so your confidence in using it is very high, even though you don't really know how to. Ultimately, on the far right, you end up getting very competent, and your confidence in using it is very high. That's the plateau of sustainability. But in the middle, there's oftentimes what's called this valley of despair, where there's a lot of hype, there's a lot of excitement, there's a lot of lofty forecasts in terms of what's going to happen, and oftentimes it takes a little bit longer for that to play out. You still ultimately get to these productivity gains, but there's often situations where the market gets a little bit ahead of itself. When we go back to our 5 main points, the first is on timing. We do think productivity gains will be likely, but they're going to be realized faster than prior tech cycles and slower than what the market's expecting. When you think about integrating a new technology into a firm, it's hard. You have to retrain people, you have to redo processes, you need to have the data, the infrastructure to execute, and that's not something that happens overnight. But if we go back to those prior tech cycles, that S-curve, we do think AI will happen quicker than some of the ones in the 90s. In terms of the broader macro perspective, we think the broader commercialization of AI will have a lag but moderately positive effect on US productivity, but probably less of an impact on GDP. Some of the estimates we've seen assume maybe 10 bips to 50 bips of GDP growth, but if you look at the historical data with computing and internet, it's kind of hard to even see an impact there. In terms of the sectors that are going to be most impacted, this should be intuitive, but we think it's the more data intensive, high labor cost sectors that can really utilize this technology to make their businesses more efficient. And frankly, it just seems like the similar sectors that were big users of personal computing and internet. The fourth point is about which firms we think will benefit. Historically, technology advantages, they don't get disproportionately distributed. There's certain firms that tend to maximize the opportunity and really use it as a lever to grow. And generally, we think that's going to be larger or well-run firms that are generally digital first, data rich, and have an adaptive culture. If you have those elements and people move quickly to use this technology to make their business better, we think they'll reap a disproportionate share of the market gains from using the new technology. And finally, with respect to the markets, if we had to make a call, I'd say the market's probably assuming a little bit too much investment in the infrastructure, benefiting too few names. And as is always the case, when you have high valuations and growth estimates raise the odds in medium term, the estimates go up, it just raises the odds of a medium term disappointment if the revenues don't pan out quickly. So in our view, it's probably the next 2 to 4 quarters that are going to be critical when we see these actual software companies, these hyperscalers, demonstrate the revenue growth. And if they do see it, I think you'll see the CapEx trend continue. If they don't, it wouldn't surprise us if there's a bit more moderation in the level of investment taking place. So that's a quick, hopefully not too deep of a summary of our views in AI. There's obviously a lot below the surface, a lot to unpack. There's impacts to the energy sector. There's impacts to the power grid. There's a lot here, but we think it's an important trend that we're very focused on. And it's frankly going to be probably one of the most interesting things, one of the most important trends we see over the next 10 years. With that, I will flip it back over to Eric. Eric, I took us way deep into the weeds. Maybe you can kind of bring us back to the fairway and offer any final thoughts or perspectives on where we are in the markets.
Yeah, I had ChatGPT record that, and I'm waiting on its summary of the AI impact.
Good.
I hope all of you as listeners and investors with us could just see the level of diligence that Scott and his team have put into this. I mean, no one has a crystal ball to predict these things, but this is far from the crystal ball approach with the level of data scrutiny that he's put into this. And Scott, thank you for your time on that really impressive summary of information. I think it's helpful for all of us. So I think my goal here at the end is to kind of keep us all out of that valley of despair if we can. I think that's our job as financial advisors, is to allow our clients to participate in these exciting trends, but to keep us from getting over allocated to too much excitement, too much of that FOMO, if you will, that fear of missing out on exciting trends, and staying disciplined with what we're doing here. This chart we have on the screen is just kind of almost a tricky chart where it's counterintuitive, where it suggests that, hey, investing on a day when the market hits a new high is not necessarily a bad thing. You may not have the best returns over the next 3 days or the next 3 months because you've kind of top picked things short term. But it's encouraging for those of us that have said, gosh, it's been a really good run in the markets here, but should I pause my investing into my 401k or into my investment? Should I take a bunch of money off the table because things are at all-time highs are starting to look expensive? And what this historical data shows us is actually those days when the markets hit all-time highs over 3 and 5 years have actually been fairly good times to invest. But I don't know if you want to jump forward another slide here. We can talk on a couple of other quick things we can wrap up. This gets back to the idea of diversification. So we talked at the very outset about the concentration in the market and how these top market cap weighted names have really driven performance. Maybe they're starting to feel a little bit more expensive. And this provides a little bit more historical perspective of when that market cap weighted, meaning the one that's skewed based upon how big a company is, outperforms. We've certainly been in a period right now where that cap weighted index has outperformed. But then we get into a period of equal weighted market outperformance. That means if you just take an equal slice of all 500 companies in the S&P 500, a more diversified approach. And you can see the parallels. If you go back to after the tech bubble burst, what was the right approach? It was to be diversified. So again, that doesn't mean we want to be too gun shy and not participate in what are very high quality companies developing exciting things. But to avoid some of that disappointment, that potential lull or waiting period for that next killer app that really shows us how AI is going to truly change society for the better, besides just helping middle schoolers write their papers faster and us maybe get our research done a little bit quicker. There's a way to play defense a little bit by staying diversified. So that would be my message here. And then we can wrap that up on the last slide for beyond just equities. Fixed income, I think, is not an exciting topic. It's been kind of an abysmal topic for the last 3 years because we've got our best year of performance up 1% right now that we've seen in the last 3. That's not very, very strong. But on a forward-looking basis, where interest rates sit today, you get an attractive level of income and some potential price appreciation or some price gains, price recovery, if you will, in the bonds, those longer-term bonds that have struggled so mightily once we start getting these interest rate cuts. So that's again, I think our job is when things get too exciting to the upside is to be a little bit more boring, staying diversified, and when things get too painful and too ugly, to try to stay middle of the road also and keep people investing for the long term and focused on those long-term risk tolerances and goals. So Will, Scott, I welcome any thoughts from you there too, but that's kind of my core message here.
Yeah, I think this last chart is probably a little bit too statistically wonky, even for me. But just so you can orient yourselves, the black dots are current valuations, the triangles are historical averages. If the black dot is above the triangle, that means things are expensive relative to historical. If the black dot's below, it means it's cheap. I would think as we do this over the next 4 to 6 quarters, we're going to see these move around. And to Eric's point, diversification It's not the most exciting topic, but it tends to help you stay on trend, stay on plan, meet your goals in the long term, even if there is some rotations happening across sectors and across your total portfolio. So with that, I think we'll thank you all for attending. As always, we love doing these. We love kind of giving information to our clients. So hopefully you found it helpful. Just a quick reminder, we got 3 upcoming events on the calendar. On August 13th, we've got our ERISA attorney talk. On the 28th, we've got our Fit for Learning series. And we'll be back with you, Eric, Will, and I on October 16th for our next edition of Making Sense of the Markets. So thank you, Will, and thank you, Eric. As always, appreciate you guys and your very smart wisdom on the markets.
Thank you.
Thanks, everyone.
Thank you.